Forget the headlines, forget the noise for a second. Let's look at what actually happened when the geopolitical shockwave hit the markets. The reaction was swift, and it was brutal. This all kicked off after those so-called leaks about the US president's speech on Iran. Fear just took over. Let's look at the raw data.
And there it is, the S&P 500, down 1.21%. That's not a gentle dip. That is a sharp, immediate plunge. That's the kind of move you see when real, genuine fear starts to seep into the system.
And then you've got the Nasdaq, which got hammered even harder. Now, why is that? It's simple, really. The threat of a bigger conflict means one thing: soaring oil prices. And there is nothing, absolutely nothing, that spooks high-growth tech stocks more than the idea of sustained inflation. All of a sudden, those rosy future cash flows, they start to look a whole lot less valuable.
And right here, this is what fear looks like in numbers. The VIX, the market's so-called fear gauge, exploded by over 6%. Look, this isn't just people selling off a few shares. This is panic. This is a mad dash for the exits, a scramble for protection when every last drop of optimism has just vanished.
So, put it all together. What does it tell you? This completes the picture perfectly. We're looking at a classic risk-off event. You saw capital fleeing from stocks, especially from tech, and in the very same breath, the price of energy just exploded. The market was screaming, absolutely screaming one thing: get ready for uncertainty and inflation.
But let's pause for a second. What if that whole scream was orchestrated? What if the chaos you just saw playing out on the charts wasn't an accident, but the intended result of a very carefully staged performance?
Let's ask the critical question here. Did you happen to notice how every single major media outlet magically published the exact same confidential information about the president's speech before he even said a word? Think about it. That's not journalism. That is a coordinated leak. So look at the timeline. It's so clear when you lay it out. Step 1, the media is spoon-fed this narrative of aggression. Step 2, the markets, predictably, react to the leak and price in the absolute worst-case scenario. Stocks tank, oil spikes. And then step 3, the actual speech happens, and nothing. Not a single new piece of information. But it didn't matter, did it? The damage was already done. And this gets to the heart of it. This was never a policy announcement meant for you or me. No. It was a message for Iran. It was a message for voters. And most importantly, it was a tool designed specifically to move the markets. We were all just the audience for a very, very cynical negotiation tactic. Okay, so that brings us to the second layer of this whole manipulation, the absolute panic around oil. You hear it everywhere, right? The threat of $100 oil is being sold to us as some kind of economic doomsday. Well, I'm here to tell you, it's not.
Now, to really understand why, we have to talk about a concept called monetary degradation. It sounds complicated, but it's simple. A dollar in, say, 2026 is not the same as a dollar was in 2008. It just doesn't buy as much stuff. So trying to compare the price of oil today to the price of oil back then, it's a fundamental error.
So here's the kicker. It's not just that the dollar is worth less. Our entire economy is also way, way more energy efficient now. It takes a lot less oil to generate $1 of GDP than it did 15, 20 years ago. You put those two things together and what do you get? The real economic impact of $100 oil is so much smaller than the panic-inducing headlines want you to believe.
And now for the really uncomfortable truth. For the U.S. economy, this entire situation is actually a net positive. It's beneficial. Why? Because the U.S. is now a massive oil exporter, so it's raking in huge revenues from these higher prices. And on top of that, defense spending is going through the roof. Think about it. They've already used up something like 20% of their Tomahawk missile inventory. Those have to be replenished. And that spending, it's a direct shot in the arm for economic activity.
But all of this, the market noise, the political theater, it's all a distraction. Underneath it all, there's a much deeper, much more strategic game being played. And in this game, believe me, there is one very clear, very silent winner.
Let's get into the weeds for a second, the technical details. Israel's defense systems, they're interceptors. They rely on these highly specialized magnets, right? Magnets processed from rare earth elements. And guess who the #1 supplier, the processor of those rare earths is? Yep, China.
Okay, now let's flip the coin. Let's look at Iran's offensive missiles. What about their guidance systems, their advanced electronics, their propellants? Well, it turns out many of those critical components are also made in or supplied by, you guessed it, China.
Do you see what's happening here? Do you see the play? As this conflict escalates, both sides become more and more dependent on the exact same supplier. China isn't picking a side. It's making itself absolutely indispensable to everyone. It gains strategic leverage with every single missile that's fired, all without having to risk a single soldier. It's brilliant, in a wicked sort of way.
All right, so we've cut through the media manipulation. We've identified the real strategic winner here. But what does this all mean for us, for our portfolios? How do we actually operate in an environment like this?
This chart right here, this is our current playing field. Forget the wild, headline-driven swings for a minute. The underlying market structure is telling us a completely different story. This isn't a crash, this is engineered noise.
What the charts are really showing is that this is all just noise inside a clearly defined range. For the S&P 500, the key zone to watch is between 6,400 on the low end and 6,600 on the high end. For Brent crude, it's a fight between $97 and $110. All these violent, scary moves, they're designed to do one thing: shake you out. But the real structure is just a sideways movement, a consolidation. And so that leaves us with one final thought to really chew on. Is any of this really about geopolitics? Or is this violent, sideways churn just a mechanism, a deliberate cleansing to wash out the weak hands, to get rid of all the nervous investors right before the massive wave of liquidity that's expected in 2026 comes in and triggers the next real, sustained move higher? Think about that.